Most people don't realize this, but medical expenses such as co-pays, prescriptions, and even dental expenses aren't deductible unless they exceed 7.5% of your adjusted gross income. But what if I told you there's a way to turn these out-of-pocket expenses into business deductions? That's where an HRA comes in. Hi, I'm Vihan Botha with Investor Friendly CPA, and today I'm going to show you how a Health Reimbursement Arrangement, or an HRA, can help small business owners deduct medical expenses in a smart way. If you're paying thousands out of pocket for healthcare, this strategy could save you serious money in taxes. Normally, medical expenses are tough to deduct. You have to itemize and spend over 7.5% of your adjusted gross income before the IRS lets you deduct anything. That means for somebody making $100,000, the first $7,500 of expenses don't even count. That's where an HRA changes the game. A health reimbursement arrangement is an employer-funded plan that reimburses employees' medical expenses using pre-tax dollars. And here's the kicker. You can hire your spouse as an employee, set up a compliant HRA, and suddenly those out-of-pocket expenses become business deductible expenses. With the standalone HRA, only the employer contributes. It's not a salary reduction. It can cover your spouse, dependents, and kids under 27. The reimbursements are tax-free to the employee, and as the employer, you get a business deduction. Plus, you avoid payroll taxes. This strategy works best for sole proprietors or single-member LLCs where they can hire their spouse, C corporation owners who run their plan directly, real estate businesses treated as active trades or businesses, and for S-corps, there's a workaround, but it's not direct. HRA can reimburse things like co-pays, prescriptions, and even dental and vision care, medical equipment and therapy sessions, chiropractic and counseling, and if integrated with a group plan, even health insurance premiums. So how do you set one up? You hire your spouse or an employee, you draft and adopt a written HRA plan, you provide an annual notice, you fund it with employer funds only, reimburse only qualified expenses, keep receipts, timesheets, and plan documents, and report it on your tax return to reduce your taxable income and reduce self-employment tax. Here's an example. Let's say your family has $22,000 of medical expenses for the year. By using a properly structured HRA, you can save them anywhere from $2,500 to $10,000 in taxes that year, depending on your business and income type. That's real money back in your pocket. HRAs are best for married business owners who have high out-of-pocket medical expenses and want to reduce their taxable income and self-employment tax. But compliance matters. You need a written plan, proper documentation, and the right setup to avoid any IRS issues. If you're ready to stop losing deductions on your medical bills and start treating them like business expenses, let's talk. At Investor Friendly CPA, we specialize in tax planning that incorporate this topic and many more. Contact us today and make sure you're not leaving tax savings on the table. Like and subscribe for more.